more money is flowing into AI companies than ever before because the company that controls AI is going to control our economy. And this is where some people are starting to get nervous. In July 2025, some investment firms began warning about a potential AI bubble. Then in August 2025, Sam Altman, who was the founder of ChatGPT, said it looks like the AI spending is building a bubble. And then most recently in September 2025, Mark Zuckerberg, who is the founder of Meta, also said that, yeah, I'm seeing the signs of an AI bubble as well. Why are they saying this? Because of the countless billions of dollars that are being thrown at AI, causing valuations to soar through the roof. So what I want to do in this video is help you understand if we're actually in an AI bubble, and then I want to show you how this can create investment opportunities for you. For topics like this, I like to start by looking at history, because while history doesn't exactly repeat itself, it does rhyme. 25 years ago, after the internet started to become popular, we saw the internet bubble pop, causing internet companies around the world to crash. That's why so many people are making analogies to the AI bubble and the dot-com bubble, but there are some differences as well, so let's break it down. Let's start by taking a look at investment funding. VC funding, meaning venture capital investments into dot-com companies, grew from around $3 billion in 1995 to about $105 billion in the year 2000, which is an increase of around 35 times over the course of those 5 years. According to Stanford's AI Index, we've seen corporate investment in AI grow from around $103 billion in 2019 to $252 billion in 2024, which is a growth of around 2.5 times. Now, that's significantly smaller than this, but we are looking at different numbers. We're looking at venture capital investing here, we're looking at corporate investing here, and I should also mention that the big adoption in AI started after the end of 2022 because ChatGPT started in November 2022. Then we can take a look at the valuations of those dot-com companies, because the NASDAQ is a group of the 100 largest companies in the stock market, which are not financial, so primarily tech companies. And leading up to the dot-com bubble, the NASDAQ had an average PE ratio of 70 times earnings, which means that if you were a dot-com company and you made $1,000 of profit, you would be selling, your valuation of a company would be $70,000 because you made $1,000 of profit over the course of 12 months. So investors were valuing companies at 70 times profits, while the historical average for the NASDAQ is around 20 times earnings. Today, at the time of recording this video, the NASDAQ, which again is a group of the 100 largest companies in the stock market that are not financial, so primarily tech companies, is trading at around 35 times earnings, which is about half where we were during the dot-com bubble peak, but still higher than the historical average for the NASDAQ, which is around 20 times earnings. So now we looked at the growth of investment dollars into the new technologies. We looked at the valuation of those technologies. Now let's take a look at how oversaturated those technologies are, because during the peak of the dot-com bubble, we saw that tech stocks made up 33% of the total value of the S&P 500. Again, the S&P 500 is a group of the 500 largest companies in the stock market. And during the peak of the dot-com bubble, tech companies made up 33% of the total value of the S&P 500, meaning the total 500 companies in the stock market. Today, this imbalance is even more severe because the Mag 7, which is the largest 7 tech companies out there, make up 34% of the S&P 500. Previously, it was the entire tech sector. Now, just the top 7 tech stocks, just the 7 companies, are making up more than a third of the 500 largest companies in the stock market by market valuation. So now that you understand the differences between the dot-com bubble and the AI bubble, let's take it one layer deeper and understand what causes bubbles to pop, more specifically, what caused the dot-com bubble to pop, and what could cause the AI bubble to pop. Now, this is where I also want to remind you that for those of you that are investors or want to become investors, I put together a brand new investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. I'll also show you the exact framework that my firm uses to research investments and find investment opportunities before they hit the headlines. It's a completely free investing masterclass. There's a ton of value in there, and when you register for the masterclass, you're also going to get access to market briefs, which is my newsletter for investors, for free, all complimentary. So if you want to get the investing masterclass and market briefs all for free, all you have to do is click the link down in the description below to register. There were 3 main factors that led to the dot-com bubble bursting, which are high valuations coupled with greed, coupled with rising interest rates, and these 3 things together popped the dot-com bubble. What do I mean by high valuations? Like I just showed you, we saw that the NASDAQ was trading at an average of 70 times earnings, which means companies that had little profits were able to sell for huge high valuations. Not to mention we had a lot of greed, and what I mean more specifically by greed is there was a lot of companies that were raising money pre-revenue and were able to raise lots of dollars. Not just that, these companies were then IPOing, meaning they were going onto the stock market and raising many millions of dollars without a viable business model and without making a penny in revenue. So there were a lot of people that were starting these dot-com companies, raising millions of dollars and then not doing anything with the companies, causing these huge valuations, and everybody was buying in because they were hoping that they were going to get rich quick. And then we had rising interest rates on top of that, because in the late 1990s leading up to the year 2000, the Federal Reserve Bank was aggressively raising interest rates as a way to cool down the economy. And as interest rates went up, the cost of borrowing money went up, which meant the venture capital firms that were investing money into these dot-com companies, the investment institutions and the banks that were investing money and lending money into these dot-com companies now needed to make a real return on their money because the cost of that debt, the cost of borrowing money went up. And that was when the money stopped flowing in, which then caused the bubble to burst, because that's when these investment institutions says you need to start making some money. And when these dot-com companies couldn't make money, well, that was when the bubble burst. And that created more panic because we started to see some big companies like Pets.com crash and collapse, which created more of a media sensation that maybe the dot-com internet is just a fad, that people are not going to be using the internet anymore. And this then created a huge dot-com collapse. Remember the NASDAQ, which I was talking about a little bit ago? The NASDAQ fell by about 78%. From top to bottom, because people thought that the internet was over and this whole technology phase was done. Today we have some similarities but also some differences. Starting with valuations, we still have high valuations. Remember, historically the NASDAQ sells for 20 times earnings. Today we're seeing the NASDAQ sell for around 35 times earnings, which is higher than normal but lower than the 70 times earnings we were seeing leading up to the dot-com bubble bursting. But there are some exceptions. For example, Nvidia, which feels like everybody's favorite company, currently is trading at around 50 times earnings. And we're seeing a lot of startups, a lot of smaller AI companies selling for 20 to 30 times revenue, not earnings. So if you make $1 million in revenue with $0 of profit, you might be valued at 20 to 30 times that. So today we're seeing high valuations, kind of like what we saw leading up to the dot-com bubble, although it's not as high as we saw leading up to the dot-com bubble. Then we have number two, which is greed, and well, that greed still exists because people are pouring money into AI companies hoping to find the next big AI winner. So that greed never goes away. But then the biggest difference here is number three, which has to do with interest rates, because leading up to the dot-com bubble, money was becoming tighter as interest rates went up, which made banks and institutions and investors much more picky with how they invested money, so less money was flowing into those industries. Versus today, we're seeing falling interest rates. In September, the Federal Reserve Bank just cut interest rates for the first time in 2025. They hinted at more interest rate cuts coming later on in 2025. They hinted at more interest rate cuts coming in 2026. Lower interest rates don't mean tighter money. Lower interest rates mean looser money, which would mean easier borrowing for institutions and investors and banks, which could mean more money flowing into the bubble. And this is the thing that I really want you to pay attention to, because this is the biggest difference between now and the dot-com bubble, because in the dot-com bubble, we were seeing the rising interest rates, which caused it to pop. Today, we're seeing a lower interest rate environment with interest rates going down. And generally, and I say this very cautiously, but generally, lower interest rates or falling interest rates don't cause bubbles to pop. They cause more dollars to flow into the bubbles, causing the bubbles to grow even bigger. That's generally what happens, and as bubbles grow bigger, when they eventually pop, that bubble then is a bigger bubble that pops. The key thing that you want to remember here is that lower interest rates don't change the fundamentals of companies. They don't make companies better. What they do is they allow more dollars to flow into those companies. So that's why lower interest rates generally don't cause the bubbles to pop. And again, generally. We could be wrong. We could see something completely different happen this time, but generally lower interest rates cause more dollars to flow in as opposed to tightening the investment strategy. That being said, we know that bubbles happen. how do bubbles also create opportunities? And this is where it's very helpful for you to understand poop, because most people have no idea of how poop works. Poop, P-O-O-P, stands for panic, leads to overselling, leads to opportunity, leads to profits. And what we have seen in crash after crash after crash is poop happens. During the 2000 dot-com bubble crashing, poop happened. During the 2008 Great Financial Crisis, poop happened. During the 2020 pandemic, poop happened. During the 2022 stock market pull down, poop happened, and it happens again and again and again. And when you can understand poop, you will figure out how you can find the opportunity to make money, because during the dot-com bubble bursting in 2000, when the dot-com bubble crashed, you had panic, which caused people to oversell. Why? Because people were scared that the internet was over, that it's done for, so people tried to get out as fast as they could. And that was when the financially savvy investors saw the opportunity, the second O, because they said, maybe the internet is not going to die. Maybe the internet will come back and the strong internet companies will be able to grow, because some of these companies were battered by the market downturn. Like Amazon stock fell by more than 90% during this dot-com crash, which creates the opportunity for profit for the patient long-term investors that know where to find the opportunity. So during the 2000 dot-com crash, poop happened. During the 2008 Great Financial Crisis, well, poop happened. Why? Because we saw a lot of panic, not just in the stock market, but also in the housing market, because people were freaking out, saying that houses don't create wealth, they create bankruptcies, they create foreclosures. And it sounds crazy today to think of it like that, but people also said that the internet was never going to be a thing during the year 2000 and 2001. During 2008, when people said that houses are a horrible investment, you should never buy a house, well, that created overselling, which created opportunity for the financially savvy. And I know this because that was when I started investing in real estate, because a lot of people were scared to touch real estate, and that created the opportunity for profit, because the financially savvy were able to come in and buy great investments, whether it was stocks or real estate, at huge discounts. Like in Michigan, real estate was selling in some areas for more than 90% off. During the 2020 pandemic, we saw the same thing happen. We saw the stock market fall at the fastest rate that we have seen since the Great Depression. Bitcoin fell by 50%, which created panic and overselling. Why? Because people thought the world was going to end. And again, this created opportunity for the financially savvy to come in and profit, assuming that you were buying good investments, because the people that thought the world was not going to end, well, they were able to come in, buy good investments, and then you saw markets rally. And again, we saw the same thing happen in 2022 as interest rates started to go up. A lot of people said that we were going to see a huge collapse in the economy, so that panic led to overselling, which created opportunity for the financially savvy to buy stocks at a discounted price, which led to the opportunity for profit. When you understand this, now you can start to appreciate how market cycles work, because we know recessions happen. We know that bubbles happen. They're a part of our economic system. But most people get scared when they hear the term bubble. But the financially savvy get excited because they understand how that can create an investment opportunity. But here's the key. The key is not to wait until a crash to invest. That works for a very small percentage of people. But in reality, you have to really know what your investing strategy is, and then have some extra cash to be able to capitalize for when poop happens. Because we never know when a downturn is going to happen. We know what's going to happen, we just don't know when. For example, over the last 100 years, do you know how many recessions we've seen? It's not 5, it's not 10, it's not 15, it's 16 recessions. And we've seen about 25 market crashes over those same 100 years. So when you understand that, you will know that, well, we average more than 1 recession per decade. We average more than 2 market crashes per decade. When you understand that, you stop being so scared by them, and you understand how they create opportunity, and you don't get sucked into the panic. Instead, you look at the opportunity. That's the way that I want you to think, because really, when money moves, it creates opportunity. And as a financially savvy investor, you want to be able to think in terms of opportunity. I think AI is one of the biggest opportunities in the world. I mean, we made a huge company pivot at Briefs Media. I've kind of hinted at it on this channel a couple of times. But recently, in 2025, I realized that if we didn't pivot our company's direction, we were going to be bankrupt by 2030. So we made a huge pivot to understand how we can create the best AI tool for investors out there, which again, I haven't announced it yet. We're going to be talking more about it in 2026. We're just developing this right now. And if we did not do this, I knew where our company was going to be going because of how smart AI is getting. So I am very bullish on AI, but I also understand how investment cycles work and how market cycles work. And I know that there's going to be ups and downs, but if you are smart with your money and you keep cash reserves to be able to capitalize on downturns, well, now you can win on the upside. And when the downturn happens, well, that creates a great buying opportunity for you to see even more winning on the back end of that. That's why it pays to be a financially savvy investor. Now, again, if you want some help on how do you actually start investing, you can check out the free investing masterclass that I have for you down in the description. And if you enjoyed this video, the best thank you is a referral. So if you enjoyed this video, please share this video with a friend, a family member, a colleague, or a fellow investor. The United States government owes more than $37 trillion. That means your tax dollars are being used to pay interest on all that debt. And this is where President Trump has been proposing a new plan to help pay off this debt involving gold and involving crypto. And most people have no idea of how this plan works or the implication of this new plan on your money.